On today's show, 4 questions. Bonus question number 1, why the heck is Matt here? Number 2, what is the Fed trying to say? Number 3, is the SAVE plan finally dead? And number 4, what's the state of the dental workforce? Let's go.
Consult an advisor or conduct your own due diligence when making financial decisions. General principles discussed during this program do not constitute personal advice. This program is furnished by Dentist Advisors, a registered investment advisor.
Welcome to Dentist Money's 2 cents, where we help dentists navigate all the noise. I'm Matt.
I'm Taylor.
And I'm Rabih.
Yeah, you are. And let's just call out the elephant in the room. We're here, guys. We lied. We lied. We said last week we made this whole big farewell to 2025. We're going to end the year, no more shows. Why the heck did we lie, and why are we still here? So first I'll tell you the fake reason, and then we'll give you
workaholics.
We're workaholics. We cannot stop. I'll give you the fake reason that I thought of this morning that I was going to tell everyone. So we had so many people reach out to us, just an outcry of people saying, no, do not take this away from us. This is the highlight of our weekend, every weekend. We cannot survive without 2 cents. I don't know how many people reached out to us. We just had to give the people what they wanted. So I delayed my surgery and I said, nay, Rabih, nay. We will stay. We will give the people 2 cents because they have to have it. That's the fake reason.
Well, I'm glad we, averted an international crisis.
Yeah. That's the reason I have in my head, that people cared so much they want us to do it. But now I'll give you the real reason. So, as I think anyone who listened last week, we again did say farewell to the show for the year because I was getting surgery. No, I am not that tough. I did not get surgery. So I had to delay because, guys, as you know, I decided I was going to lose the whole ski season with my back surgery. So I thought, well, I want to get up there at least one day with my kids. So I take my kids up. My kids love to ski. So I take my kids up to ski for the just first and last day of the year for me. And what happens? My daughter breaks her leg. So she broke her leg skiing with me. And she's non-weight bearing for 6 weeks. And so I can't exactly be post-op, not being able to lift anything over 10 pounds for 6 to 8 weeks and have her be, incapable of moving on, without help. So here we are. I pushed out my surgery till January. My daughter is now on crutches, and 2 cents is back. That's the result of, it's not because anyone cared. It's because we thought we got nothing else to do. Matt's still here. Let's do the show. So anything you guys want to say, first of all, to 2 cents being back for a couple more shows?
I'm just glad that Matt's still here. That's what I'm happy about. Who cares about 2 cents? We just get more Matt in our lives.
There you go. We're going to really test Rabih's. So I'm getting surgery now mid-January. And so I'm going to be out for at least a couple of weeks, is the plan. So we're going to really have to test Rabih on this, his resolve of doing 2 cents without me.
No, we're not having 2 cents.
He's just like, no, we're not. We're going to pre-record. Okay, perfect. Well, let's jump in. We're glad to be here. Sorry we lied. It was not intentional. We have a couple more weeks of 2 cents. So the real number one question, Rabih, is what is the Fed trying to say?
It was another meeting, Matt. So you know what this means.
That new car smell.
The new car smell.
Yep.
And, it's an upgrade. It's this once a quarter where they give you the summary of economic projections. This is only, one of the 4 times in the year where you can sit down, read what the Fed is trying to tell you about how the economy is growing, what unemployment is going to look like, what inflation is going to look like, and what the path of interest rates is going to be. And it's one of the first time where the whole market, and I'm talking equities, fixed income, everyone is sitting there reading the same piece of paper, trying to make decisions. And we're starting again from a shared common point.
Which we know so many people were doing that. They were sitting down and reading this for sure.
At least I was.
Yeah. No, it's like NFL viewership is barely first, just barely ahead of the summary of economic projections. Yeah, totally.
Yeah. If not, yes.
I love Rabih's sheepish. I was
yeah.
Rabih was totally there.
What were you guys doing with all that free time?
They're like, oh, you're the one. You're the one, Rabih. You were the one that read it, that downloaded this report.
I kid you not. It gets released at 2 p.m. Eastern time, noon Mountain time sharp. And I was on the website refreshing at 11:59, 11:55, and 59:30 seconds. And then when it dropped on 12, I downloaded. You want to read it before, like, as soon as you can.
Just like, we just had Nate Bargatze, who came to Salt Lake. We all went as a team for our Christmas party, and he sold out shows so quickly he had to add another show because he's like so big in Utah. And that to me makes sense. Rabih doing that, like, it's like the equivalent of people like clicking refresh to get Nate Bargatze tickets or like a concert or something. And Rabih's like clicking, like, Rabih, I promise you, you're the only one downloading this right now. It's fine.
or to reference one of his jokes, the rest of us are refreshing our DoorDash coming up, and Rabih's out.
Yeah. There you go. We're like, where's our DoorDash? Rabih's like, where's the new car smell? I need the economic projections.
Well, guys, don't be too harsh on it. Let me read it for you, and you
Rabih.
judge whether it's worth the anticipation or not. So the first thing that the Fed mentioned is what they expect GDP to be for 2025. And previously in September, they said, the GDP is going to only grow to 1.6% in 2025, real GDP. So after inflation, now they're saying it's going to grow to 1.7. But this still doesn't make lots of sense because if you take the return of Q1, Q2, and Q3, we've had a solid year, especially Q2 and Q3. We had growth over 3% annualized in those 2 quarters. So for us to finish the year at 1.7, this means that Q4's growth is only going to be 0.4% annualized, or like 0.1%, which honestly doesn't click. Like, you guys have seen how much traffic there is, and like how we broke records on Black Friday, Cyber Monday shopping.
Yeah, multiple records.
Like, the consumer is on steroids this holiday season. How can we expect the economy not to, to only grow 0.1% or 0.4 annualized? So the number of only getting 1.7% for the year is kind of catching attention. But something that is interesting that showed up in the conversation with the Fed chair is that for 2026, their projection back in September is that 2026 is going to be a year where the economy grows 1.8%, which is kind of average. And now they're saying it's going to grow 2.3%. So above average rate, it's a really good economy. And they said, well, this 2.3 is really just the reopening of the economy after the shutdown. They think that 0.2 out of that 2.3 is actually supposed to be in 2025. So we would be growing 1.9 in 2025 and then 2.1 in 2026. But because the government shutdown happened, they are taking 0.2 from 2025 and throwing it into 2026. Kind of saying that, the government shutdown had an impact on the economy, and we were supposed to grow 1.9. We're growing 1.7 because of that government shutdown. But still, even if we want to end the year with 1.9, given Q2 and Q3 and how strong they were, it means that the economy in Q4 should only grow 1%. So you're telling me, or 1.2% to be mathematically accurate. So you're telling me we had Q2 where we grew over 3% annualized. We had Q3 where we grew over 3% annualized. We grew Q4 with the government shutdown, but the economy is still very strong. And we're going to end up the year at 1.9. It
doesn't make any sense.
So if we won't get Q4 numbers until March, but if March comes and we see that the economy has done better than we expect it to do, or what the Fed said it's going to do, we could expect a positive surprise. Those are, expectations are baked in, and the expectations that they're baking in is like normal growth where we're having really good growth. So that's a positive surprise. You guys can, extrapolate what would do that to prices and, the momentum for around the time that gets released. The other thing that showed up, and not really much improvement, is unemployment rate. They think is going to stay between 4.5 and 4.4 from now until the end of the year and then next year. They also think that inflation right now is going to end the year at 2.9 and next year it's going to average 2.4. So it's going to be a while until we go back to that 2%. It's like they keep kicking the can down the road. And the core PCE inflation is 3 for this year and 2.5 for next year. Okay, so what you're telling me is that we're going to have a stronger economy, but the unemployment rate is going to stay as is, the inflation is going to stay as is. This gray zone limbo period that we've been in for the last, year is going to continue, but now more economic growth. Great, they're attributing to this increase in economic growth due to productivity growth. It's been one of the very rare times in history, according to Jerome Powell, where we've had 5 to 6 years of 2% productivity growth. And he said this is way before AI. He said this is probably induced by the pandemic and how it changed our perspective to life. And that has translated to 2% productivity every single year. Do you guys agree with the pandemic actually changed how we do work? I don't know, other than work from home, right? And made us more productive. But that is being thrown out.
They're saying the theory is that the pandemic made us more productive.
Mm-hmm.
Interesting.
Because this is the first time we see a series of 5 to 6 years where productivity growth has been growing at 2%, which translates why we're having a stronger economy with the same unemployment numbers, with the same inflation numbers.
Yeah, but I know I get that. I guess I'm trying to connect the dots between what with the pandemic, what connection to the pandemic is there? I would have thought the pandemic is it's a known thing that the pandemic led us to more of a mindset around work-life balance and our priorities. And I don't know if someone said, hey, in 6 years from now, we're going to be looking back and this has made us more productive as an economy. I don't know if I would be able to, or I don't know if I'd have a rationale for that.
Yeah. I mean, I can say from my own experience, going from a spot where I was primarily in office to now being primarily at home, I do, while there are distractions are just different. They come in different forms now. I do feel like I'm less distracted at home than I was at the office. And that's just
because I'm not there.
Well, when you're, it's probably Jake Elm specifically. Shout out Jake Elm. But
yeah, it's probably
when you're in the office and there's just 10 people surrounded, you're in one open space with 10 people and there's just chatter and people talking and different things. There's benefits that come from that. There's culture and collaboration, but there's also just when I need to get work done, it's really, really hard when there's that many distractions.
Yeah, I can see that.
At home, I can just shut my door, I'm locked in, and I can just get a ton of stuff knocked out, right?
Yeah.
The other thing that I think has happened, and this comes from, shout out an article that I wrote a couple months ago, but there's been a prevalence of people with work-life balances being worse, right? People needing vacations from their vacations. And just because the prevalence of work coming home, right? We've actually had a harder time as a society shutting work off because now we all have a setup where we're not leaving the office computer and not having access to our email. Everyone's got their email,
24/7.
Everyone's got their setup. You can get a hold of people, you can get work done. And I routinely, right? And I know this is for other advisors as well. I'm routinely working. I'll put the kids to bed at 8 and I'll work from 9 to midnight a lot of nights.
Yeah.
Right. Which I was not doing back before pre-pandemic.
Yeah. That's interesting. I can totally see all of that. I guess it's a personality thing. It depends on if at home are you more productive? Are more people productive at home versus not? I've not seen the data on this, but maybe we're saying, Rabih, based on the metadata, the macro data, we can make the argument that people are more productive at home overall. Generally speaking.
It's a very valid hypothesis. Actually, the context in which this came was the reporter was asking, so we're going to have the same macroeconomic conditions but stronger growth. Is AI causing this productivity? And then the chair of the Federal Reserve says, no, we've been seeing this productivity for the last 5 to 6 years. So it's more likely an event like the pandemic that's caused it than it is AI. But if this is a trend and now AI is going to make us even more productive, expect even more real economic growth, which is a happy story. Right? So this is one side of the coin. The other side of the coin is interest rates, right? So we're getting better economic growth, same, inflation that's slightly higher than what we wanted, unemployment rate that is worse than it was a couple of years ago, but historically is still below the average, below the 5 level, below the 6 level.
It begs the question, Rabih. It begs the question. Go ahead. On the interest rates.
Begs the question. It's so why are you cutting interest rates? Because they cut interest rates 25 basis points. Or why are you not cutting? Why are you making that decision to start with? And the argument is that the Federal Reserve now thinks that all the remaining inflation is due to tariffs. Like if you run models and you look at your inflation data and how it's been trending pre-tariff being introduced, they are so close to the 2% level that they want. The only remaining chunk that's putting us at this constant inflation level is due to tariffs, and they still think that the tariff impact is a one-time thing. Now, remember in 2022, they were like, oh, this tariff thing that wrecked the whole economy was transitory. It's just a one-time thing, but it ended up trickling down through the whole economy and making the inflation problems of 2022. Now they're saying inflation is gone in a sense, but those tariff impact are transitory and they're just going to be a one-time job. Will they or will they not be? It really depends on whether the president keeps adding new tariffs or whether we just stick to what got introduced. The other thing which I found very interesting and why they are supporting the idea of cutting interest rates now and why they think one more cut is going to happen in January is because they think, because of the government shutdown and the delay in the data, the unemployment data that we've been receiving is overstating how good the job market is. So he said that the unemployment data that gets reported is usually a survey data. So they're surveying a bunch of people and you're estimating how many new jobs were created, how many people filed for unemployment, etc. And according to their estimates, they think that we are probably 60,000 jobs less a month than what is being reported. Do you guys remember a couple of months ago when they made that adjustment and they said, oh, the economy had 800 to 900,000 jobs less than what was expected?
Yeah, didn't someone get fired over that?
Yes, and the administration blamed, the previous administration, etc. This is something systemic in how we collect the data, and they correct it every twice a year. So putting aside the political games, this is something that's going to happen every 6 months, where they're going to be correcting the data. And the Federal Reserve saying, seeing how the trend of them correcting the data, we expect to have an upward bias of 60K jobs a month. We are overstating them by 60K jobs a month. So now the last reading of how many jobs were created in the economy, which was 40K back in September, actually was a loss of 20,000 jobs, not a gain of 40,000 jobs. So for that reason, because they think the data that we're getting from the Bureau of Labor Statistics are overstated, they are cutting interest rates because they think the labor market is already weakening. So this is where that puts us. We're going to only get no more. Well, 2025 is over. According to their suggestions, interest rates for 2026 are going to be one cut lower, and it's either going to happen January or February, according to what markets are predicting. But I still do not buy the idea that the Federal Reserve is leaving in March. Last meeting in March. He's leaving in May. The administration is going to bring in a new chair of the Federal Reserve that is very aligned with the current administration, that is pushing for lower interest rates, and that person is going to hold office for 6 meetings and not cut interest rates anytime.
Yeah.
So I feel like we're going to have a regime switch. From now until Jerome Powell leaves, we have this mindset, and then we're going to have an adjustment period where we're going to have a bunch of noise, and then a new framework or path will be set for us, and the market will react accordingly.
And Rabih, on the change of the chair doesn't necessarily mean that is automatically going to, like, obviously we know that it's going to be President Trump's appointee, and they're going to be much more focused on cutting to fill his agenda. But it's a committee, as we've talked about. So it still doesn't necessarily mean like, oh, all of a sudden we're going to see immediately multiple cuts, because there's still a committee of 12 members.
There is a committee of 12 members, and the thing is, you've got 7 who are not related to Federal Reserves, so those are the ones Trump can control, and he's probably going to have 5 out of these 7. So he's going to heavily influence the vote. To what extent, we'll see what happens with Lisa Cook, what happens with Jerome Powell, if he stays in the committee but not in the chair position, just as a voting member. All of these are going to change the politics and sway the vote. But if you look at the dot plot, which is the tally of how everyone voted in that committee, we're seeing 2 groups. We're seeing like a divergence. They're clustering in 2 separate ones that want to keep interest rates where they are, others that want to have it much lower. And probably with the change of the chair, a seat here or there, that might tilt the voting in one direction. And yes, it could be possible that now we have a new flavor for that committee that is more, how they call it in the market, dovish. They'd like to cut interest rates even further. That means slightly higher prices for a while.
Taylor, anything on this you want to add?
No, I think, we just kind of have to wait and see how it plays out. I think anything that happens, there's both good and bad that'll come from that, right? I think there's a lot of people that are waiting around to do a lot of things if interest rates drop, and there could be good that comes from that. But there could also be higher inflation that comes from that. Like, we just don't know what's going to happen, right? We can predict, what we think that, how the pieces will move, but we can't predict the reactions to those pieces.
Yeah, I'm still confused, Rabih, and I guess we'll need more rationale or information moving forward. I still can't wrap my mind around the justification for the lowered real GDP. That still just throws me off.
Lower GDP, the 1.7. Like, we're gonna end the year with 1.7, but we still have very strong. Yeah, I don't know. Maybe we're gonna get that. Maybe the government shutdown is that important that we are gonna move from a 3% to a 0.4. We'll see.
Yeah, we'll see. Okay, let's move on. Taylor, one of our resident student loan experts, we had a pretty recent, pretty big update on a press release from the government on student loans. Taylor, is the SAVE plan finally dead?
Yeah. So I think the simple answer is almost, right? It's on
its last breath.
It's almost dead. So just to kind of give some background before we dive into this press release. So this was released on Tuesday. We're recording this on Friday. If you listen to any student loan podcasts or follow any outlets, you probably already heard reactions to this. But basically what's happened is, in the past with the student loans, the One Big Beautiful Bill made a major overhaul and major update to the system. And they said, hey, all old plans that haven't been congressionally approved are going to be sunset out by no later than July 1st of 2028. So that means SAVE, repay, ICR, right? Any of the old income-driven repayment plans outside of IBR were going to be sunset July 1st of 2028. But SAVE specifically was, hey, this plan is going away by July 1st of 2028 or sooner, right? And that or sooner was dependent on a pending court case that had been going up the chain. Basically, we weren't going to get a decision until it made it to the Supreme Court and they'd made a final ruling on it, right? This update that came Tuesday basically answered that question of, will the SAVE plan be gone July 1st of 2028 or sooner? And the answer is sooner, right? So we still don't know exactly when, but the press release came out and said, very soon, the SAVE plan will no longer be available. And anybody on the SAVE plan will need to get off of the SAVE plan. If you do not, we will make that election for you. Right?
They'll just pick.
So pick. And that's the thing here. Like, I've had a lot of discussions with clients over the last, really since August, when the interest started accruing again for student loans. I've had a lot of discussions with clients, and the choice has become, one of three things. Do nothing and stay on SAVE, because even though interest is accruing, you still have a zero payment right now, right? And for some people, let's say they're in a startup, cash flow's tight, they don't have the capacity to start out, they're just licking their wounds and taking the interest hit. Option 2 was to move to a new income-driven repayment plan. The downside of doing that is when you change income-driven repayment plans, you have to recertify your income. And for everybody on the SAVE plan, they have not had to recertify their income since 2019. So recertifying your income meant that more than likely your payment would go up by quite a bit.
Way up, yeah.
Right. And the third option people have had has been do a private refinance, right? Just take them out of the federal loan system altogether. Interest rates have been good, right? There's been as much as a 1 to 2% interest rate savings, refinancing away from the federal system, right? So those were the three options in August. Now we're just going to be down to two options, right? The option of staying on SAVE and just playing it out is no longer going to be there for more than a few more months, right? And so again, they did not specify in this release. They just said it's happening soon, right? But if you read the tea leaves and listen to experts, most people believe that this will be no later than July 1st of 2026. And that coincides with the new WRAP plan, which for all intensive purposes, it's very similar to the SAVE plan, right? So you're either going to have to do it by July 1st of 2026, but some people think it may be as early as, February of 26. So long story
You've got
short,
to do something.
yeah, the SAVE plan is almost dead, right? And you will have to make a decision. If you are still on SAVE, you will have to make a decision one way or another by probably July 1st of 2026, right? So instead of having that zero payment for the next up to 3 years, you might have, 6-7 months left.
Big change for a lot of people, depending on the situation that you're in. I guess the silver lining here, it's still not great, again, depending on your situation. We've been helping a lot of dentists with private refinances because their situation has just changed since 2019. They now have cash flow, and they're the one real huge benefit of going private is just the clarity that comes from it, of just like, okay, we know what we're doing. We're on this 20 or 15 year, whatever it is. We know our payment. We're factoring into our budget. But the other kind of good thing here is rates are actually pretty favorable right now on the student loan side. Taylor, I don't know, what have you seen lately? I mean, I've seen as low as in the 4s for some people.
Yeah, it's depending on the time frame. Like if you want to be really aggressive and do a 5-year versus a 20-year, they're going to give you a better rate on the 5-year. But if we're talking 20-year, which is the longest you'll get on a private refinance, which again, if you listen to us and you know us, we tend to say go with the longer time frame. It gives you more flexibility. You can always pay more if you want, right? But going with a longer time frame gives you more flexibility on your minimum payment, right? And I've seen back in August, there was because there was this giant demand for a lot of people to refinance. I saw people that were getting in the 4s with their 20-year. Recently, I've had my clients getting about 5.5, which again, for a lot of federal student loans, you're at like 6.5, 7% on your average weighted interest. So there's still a good 1% to 2% interest savings that's happening with student loan refinances right now.
Does this only make sense to those who had to pick up loans after 2019 or 2021 in a sense? Like those rates do not compete with someone who had an student loan taken out back in 2019 where interest rates were much, much lower, right? Does it compare? Is it favorable to refinance?
Honestly,
no matter when
so
you
those
started your
6.5, 7% loans, Rabih, are from people that were graduate. Well, so anyone that had existing loans before then might have even been higher because rates were even higher before. But that was from people that were graduating in that time frame. Honestly, people that are now graduating might have loans that have been even higher, right? I've seen some people who have loans as high as 9, 10% with recent last 2 years on their student loans.
Yep.
So even though like the Fed and mortgages were really low, student loans were not that low on the unsubsidized, especially, we're talking to dentists. And so they're taking out unsubsidized graduate level student loans. So they were still, even at their best, they were getting like 5.5. But that's just for the few semesters that the interest rates were low. And when you have a 4-year dental degree, chances are your weighted average interest rate is going to be closer to that 6.5, right? Best case scenario. And I've seen, like I said, I've seen high as 7. I've seen some recent graduates with as high as like 8, 8.5.
Yeah, I've seen same thing. Usually the ones that I've been working with to get them over to private refinance have been in like that 6.5 range. So all right,
but
more to come. SAVE plan.
The core like decision is still the same. Like if there's a chance, like again, if your income is lower, because that's what an income driven repayment plan is all about, right? The payment's derived based on your income. So if your income's lower, not much has changed. Like an income driven repayment plan is still going to give you a benefit, right? It's going to give you relief, give you a lower payment that you have to make on your student loans. Now, the details of what's happening based on which plan you're on are different, but at its core, if you have a lower income and you're still a chance that you can achieve forgiveness, there's still income driven repayment plans available to you. right? However, if your income goes up, just like it was pre-COVID, if your income goes high, you didn't want to be on an income-driven repayment plan anyways, right?
Yep.
And even with the save plan, the only reason why it's been so beneficial over the last 5 years is because the save plan for everybody that, from 2019, 2020, they didn't have to make a payment. They were using a really artificially low income. And because there was
Yep.
no recertification of their income, even though their income was growing, right? They had this thought in their head that the save plan just means I have a low payment. And if the save plan even were to stay, if something crazy were to happen and the save plan were saved between now and the next 6 months, if they just made people recertify their income, all of the people that are doing refinances and it makes sense for them to refinance would be refinancing anyways.
Yep.
Like the only reason why people are staying on the save plan that have had their incomes grow is because they haven't
Just for
had to
no
recertify
payments.
their income for 6 years.
Yeah.
Right.
So either way, that train's off the tracks. It's done.
If your income's
sometime in
high,
the next 6 months.
yeah, if your income's high, you should be getting off an income-driven repayment plan anyways. But some people have elected to stay with the zero payment, and rightfully so, right? If you're paying 6.5% on your interest, but you have extra money you can invest in the market, well, the long-term average of the market's 10. So I've had clients that have been like, I'm just going to keep making a zero payment. I'm okay paying the interest at 6.5 because I'm earning 10 right in the market.
Well, and it's worked out great in the last 3 years because we've been doing reviews of our portfolios, and we're talking like 18, 19, 20% average the last 3 years. So that arbitrage has definitely been there.
It's worked out.
It's worked out really well. But the party's over. Like it's at this point, like I think that's the hardest part for people to mentally grasp is the idea that I'm no longer like now, like I've got to face my student loans now. One thing I'll add here too, I get this question a lot, Taylor, I'm sure you do too, from clients and dentists out there is, well, I'm just kind of hanging on still because I have this hope that possibly there's going to be some level of forgiveness out there. And I tell this to dentists all the time, and I will say this publicly to all the dentists listening, the dozens of you that listen to this show, that it's not going to happen. Like even if there is forgiveness, let's say there is some change and the political party in power flips in the next election, and they put something in place for forgiveness, it's not going to apply to you, dentist. I'm sorry. It's just not. It's not meant for the dentist making multi six figures plus.
No, the save plan was the most beneficial one we've had so far, and it had so much pushback. There was a court case that came against it. Right. And to your point, Matt, it was only beneficial because their income was artificially low due to COVID. Right.
Yep.
And they weren't forced to recertify each year. If save plan were still in effect, again, most beneficial plan from a forgiveness perspective and saving on interest perspective for low income earners. Right. If you have a high income, it doesn't matter. The plans are not going to be for you. Right. Yeah. And I always tell people forgiveness is worst case scenario. If you are on a plan for 20, 25, 30 years and you achieve loan forgiveness, that means your income had to stay low enough for 20, 25, 30 years, most of your professional life, where you couldn't pay your student loans back. Yeah. That's a worst case. Like forgiveness is not what you want to shoot for, right? Best case scenario is your income, explodes and you do really well and you're forced to do a private refinance. That's what we want. So if you get there, pat yourself on the back, right? Yeah. You've done something right. Like this is not a bad thing. This is a good thing. Like I want each and every one of my clients to get to a place where they are forced to do a private refinance because that means your income has grown, right? That's a good thing.
Yeah. We rarely, if ever, have seen, and certainly rarely, if ever, have encouraged a dentist or a client of ours to shoot for forgiveness. Like I don't think we've ever said that. Very rare cases. I'm not going to say never, but it's pretty rare.
There's extenuating circumstances, but most of the time we're like, hey, use this for a couple years. It's a great stopgap. And then let's grow your income and then, put it on a 20-year timeline and ride off into the sunset. Right.
Yeah. Awesome. Okay. More to come. I'm sure we will be hitting updates as we get more kind of turning into 2026. Last question here. What's the state of the dental workforce? We said this a couple shows ago. We're trying to mix in more dental specific things because weird somehow, that makes sense. We only work with dentists. But I've been tracking some reports and things that come out from the ADA and Health Policy Institute. The most recent report, a pretty robust report. We're not going to have time to hit all of it. I want to hit some highlights. But it's this basically the U.S. Dentist workforce. So they've pulled data up until August of this year. And a lot of it's based on total year data. So it only goes up to 2024. But in this report, and you can find this on the ADA website, it's again through the Health Policy Institute and the ADA. They in this report they ask 4 questions or try to answer 4 questions, which is who makes up the U.S. dentist workforce, how and where do dentists work, how are you practicing, or how are practicing dentists doing economically, and what does the future of dentists look like? What's the workforce look like moving forward? So they go through all this, and again, we're not going to have time to go through all this, but I want to hit a couple of highlights. So first thing I actually want to highlight here is DSOs obviously being a huge part of the narrative in dentistry over the last 5 to 10 years, but it's really exploded in the last 5 years. I want to hit this first. So the percentage of dentists affiliated with DSOs, this is as of 2024. They only have the full year data. Honestly, I bet it hasn't changed a ton in 2025 just with the activity of DSOs this year. But as of 2024, the total affiliation with DSOs is 16% of dentists. Does that surprise you guys? Does that seem high, seem low, about what you thought? What are your guys' thoughts on that figure?
Anecdotally, it seems low. And I'm just going based off of conversations I have with clients and how often people bring up DSOs, and it's kind of that like hot button issue, like so many people are talking about it, so it makes it feel like it's more prevalent than it is, right? So 16 feels low, but on the other side of the coin, it's also kind of a staggering number. It's a pretty high number when you consider there's, about 200,000 dentists total in the US.
Yep.
That's 30,000 dentists associated with DSOs.
DSOs. Yeah. Rabih, do you have any thoughts on that? Did that seem high or low to you? Oh, we lost you.
No, what I'm saying is that for me, that sounded immediately low, but this also says that there is more room for them to grow, right? They haven't captured the whole market yet. So this DSO phase is still here for years to come.
Yeah, I think that's a way to look at it for sure. Is there's potential there? Like I think DSOs and private equity would certainly look at that. The other side of that argument, I would say, and I've had this. This has been an argument that I've made. Not saying I'm right, but my argument has been it's been harder to consolidate dentistry than I think they realized. And when I say they, I mean private equity and these groups. I think they've had a bigger challenge than they thought. I think now there's more resistance than ever, and for good reason, because there's a lot of crap out there. And so, yes, I agree with you, Rabih, that there is more potential, and this is going to continue on for sure of like this push. But I also think when I say it's been harder is because I've sat on panels, I've spoken at events over the last few years with different people affiliated in some form or fashion in this space, private equity, brokers, DSOs. And over the last few years, I kept hearing talk about the consolidation cycle. And I was like, oh man, like consolidation, it's happening. You better get on now. Like we're going to be, I can't remember obviously the exact figures, but based on what they've said, I would have anticipated that number to be closer to like 40 to 50 or 60% higher as of now, based on what I've heard over the last few years. So you could call that like, well, they were incentivized to say that, like brokers and things, like creating urgency and all that for sure. But I also think, just generally speaking, I really do think a lot of these groups have misread kind of how easy this was going to be. I think it's been harder. And I think really there's been some challenges and some pushback. The dental space is small. People start to realize like that word spreads, a big DSO goes under, dentists all talk. I hear this all the time from dentists of like, man, my buddy and his study club, like they're so anti-DSO because they heard about this, that, or the other. Like I think it's becoming harder. So, and obviously cost of capital and the macro environment has made it really challenging as well.
Yeah,
so,
I think just to piggyback on that, Matt, like I think interest rates have played a role in it, but I also think, to what you said just barely, like I've always been blown away. I mean, I know you and I, Matt, when we were little kids, we were saying we wanted to be dental specific financial advisors when we grew up.
My dream. It was my dream.
I was honestly shocked coming into this career at the support group and just the infrastructure around dentistry. Like there is just a really, really great network of providers that help educate dentists on the different areas of their business. And I've been blown away at just like how good the support has been around DSOs and just educating dentists and making sure that they're going in eyes wide open. Like, hey, this isn't as good as they're saying. Like, make sure you read the details. Make sure we understand this. And it makes me a little proud of like just dentists as a whole of like, hey, they're going in more educated than I think that the private equity groups were prepared for. And they're pushing back and they're getting better deals. When they do get a deal, they're getting better deals because they're more educated, they're more informed than these larger groups would hope, right?
Yep. Well, they're not giving into the fear mongering, right?
No.
There's a lot of fear mongering out there. There's a lot of disinformation. We're not shy about it. We still firmly believe and are trying to empower and protect private practice ownership. So this is something we put our flag in the ground on. And with that said, so 16% are affiliated in some way with the DSO. 73% of practice ownership is still one location with either two or less dentists. So 73% are still that private practice solo doc and or one other doc in that office, which I look at as a great thing. Again, to your point, Rabih, I think DSOs and private equity looks at that and says this is still very, very much ripe for consolidation, which I think is true. If you expand out to this next tier up, which is 2 to 9 locations, or less. So if you include the single locations and then the multi-location type places before they get to 10 or above, that's still 83% of the market. So still a good chunk, or just kind of that like solo owned or maybe partnership type practices, which is great to see. Taylor, you mentioned this, but as far as the number of dentists out there, it's steadily grown since 2001. So as of 2001, there was about 163,000 dentists and change. We are now up. We've been up over 200,000. It's held pretty steady since about 2018, roughly, or 2019. That's where we hit over 200,000. Now as of 2024, about 202,000 dentists and change. 4 out of 5, so about 80% of dentists, 78.8 exactly in 2024, are GPs, which doesn't shock me at all. One other highlight here is that dentists are getting considerably younger. So there's a huge kind of retirement cliff, they're calling it, of the share of, the baby boomer dentists have started to leave the workforce. If you look, I don't have it up obviously on the screen, but the kind of the pie chart is moving, or the number of dentists are moving far, far to the left of the scale. Where that like 30 to 40-year-old dentists are growing quite a bit. Again, not a huge shock, a much larger supply of younger dentists. And then we've said this before, but more female dentists are entering the workforce by quite a bit. And actually, the percentage of females to affiliate with the DSO is far higher than males. So that's also been part of this kind of movement of DSOs, is that it's just stating the data that females are much more likely to affiliate with the DSO out of school than a male. And because there's more females coming out of school in dentistry, I think that's kind of played into the data as well. I'm going to stop there for a second, see if you guys have any thoughts at all.
No, and I think that's a natural thing. Like, again, women are amazing and they have to do a lot more than men do when it comes to rearing, having children, right? And specifically, and I think there is a lot of comfort. I've got both male and female clients, and there's a lot of comfort with females when they have a DSO that will give them a maternity leave, or they have coverage when they're going to take 3 months off to have a baby, and they are not just like a single location owner where they have to go find somebody to pinch hit, right? And so you find that a lot more with female dentists, where they do like having that group and or partnerships early on in their career. But I say later on in their career, which I think Matt, we talked about this earlier, you do see them go out and do practice ownership as well. But it seems like that happens after they've started having their kids.
Yeah, definitely. Rabih, any thoughts on that at all?
I think the split isn't as much male-female as much as it is people who want to run a business versus people who want to offload that and just work about getting paid for their craft. And there is a market for everyone in that sense. Private equities are trying to capitalize and win the market for those who don't want to be business owners.
Yeah,
Simple.
totally agree. To put some numbers to this, the share of female general GPs from 2001 to 2024 has more than doubled. So in 2021, we had about 17% of GPs were women. Now it's about 40%. So it's that's quite the jump. And pediatric dentists has gone from about 26% in 2001 that were female. Now almost 57% of pediatric dentists are with, which is interesting. As far as a couple other highlights here, and then we'll move on. Again, you can find this report on the ADA health policy website. They talk about kind of location specific. I won't talk about that. They do highlight that practice ownership rates are dropping over the years, which again connects well to the other side of the data, which is that more affiliating with DSOs. So as of 2005, 85% of all dentists were practice owners. They only have up until 2023. That's now dropped to 72.5%. For male dentists specifically, it's gone from 88% down to 80, and then female dentists have dropped from 68 down to 60. Again, I don't think there's any shock there. I wanted to hit a couple of other things really quick. I think this will be interesting for dentists to hear, and I wanted us to have a couple minutes to talk about income. So the GP net income is declining. According to this report. So in 2010, the net income, what I need to dig into more is what they're categorizing as net income. But they say their income went from, in 2010, $267,000 in change per year, down to, as of 2024, $207,000 or $208,000. That's adjusted for inflation. So either way, they're indicating that GP income has dropped dramatically. I would want to look into that methodology of what they're looking at, but what are your guys' response or reaction to that, if anything?
Yeah, we briefly discussed this earlier, Matt, but it is a little shocking to me because that, again, compared to our average client, is just way off that number. And that might just be, confirmation bias. Like we have clients that are successful and then they reach out because they're successful and they want to work with us. Yeah. But I would be curious, as you mentioned, just to see what the definition of that number is. Like, is that just W-2 wages? Is that factoring in business income? Because if it's W-2 wages, I can totally see that. But if it's with business income, that would be like, I would be shocked. And I'd be like, that's a really concerning number to see.
Yeah. I would agree. Rabih, do you have thoughts?
Yeah, not dental specific, but more of like industry. We tend to head towards specialization. So whenever, the skill set is more general and can be offloaded to, lower levels of, I don't know, can a hygienist start now? Like compared to 20 years ago, does a hygienist now do more of what a GP used to do? Right? Is the skill set being offloaded downstream? And in that sense, it's just how markets work. And we focus on specialization and we give more value to specialization.
Yeah. And also keep in mind too, this is the result of DSO affiliation. This is what's going to happen. The more you have consolidation, the less pricing power you have as an individual. That's just how it works. And that you will see price or income pressure downward when the more a direct corollary to income's dropping, the more consolidation increases. That's just how it's going to work. It's happened in the MD space. Anytime you have this consolidation, you're going to see lower incomes at the GP or at the doctor level, staff levels, things like that. So I think that could be playing a factor as well. But I'm with you, Taylor. I'd want to look more into that income, what they're factoring in there. Again, it could be some selection bias by us, but we're seeing easily double those figures and more. On average for clients we work with, if you're factoring in total income from practice, not just like W-2, that would be interesting to dig into more into those numbers. Last couple things here I want to highlight. They're talking about like the future of dentistry. I'll just hit a couple of highlights. More dental schools are now opening up. So since 2001, 21 new dental schools have opened in the U.S. with a total of 75 dental schools as of 2025. So not drastic. If you look at the chart here, it's not crazy. They had some closures like in the late 80s and 90s, and they've had quite a few openings since in the 2000s. So, but overall, more dental schools now. Most we've ever had, 75 dental schools across the country, which is leading to more dentists coming out of school. And then dental school applicants are also up as well. So about 12,500 dental school applicants as of 2004. The report basically indicates that the dental space continues to grow and will continue to grow with the number of dentists coming out. Let's end with this question as we look at this data. I want to hear from both of you because I get this question a lot. With everything that's happened, all the changes, DSOs, cost of school, all of this, is dentistry still a viable or quality career and profession to go into? From your perspective?
Unequivocally, yes.
How many times have we joked in the office that we chose the wrong career path, and we did not go into dentistry? It's still viable and it's thriving.
Yeah, totally agree. Easy answer. Absolutely yes. Landscape has changed. Different challenges than maybe your dad's dentist or your grandpa's dentist had to deal with. But I look at there's so many opportunities and things now that they didn't have in the past, and still an incredible career for sure.
And
So
I would
totally
also
agree there.
I would put a small caveat of it's going to be an amazing career if you do want to be a business owner and you're a little bit more of a self-starter. If you're just looking to go be a W-2 employee, there's nothing wrong with that. But I'd also say there's a lot of other careers out there that would be probably more flexible and give you similar incomes if that's what you're looking for. But I would say the person who's a self-starter wants to be a business owner. Dentistry is just an incredible career for that. So good.
Totally agree. Awesome, guys. Well, our pump fake episode of 2 cents. I love it. I love that we apologize again for the pump fake and the unintentional lie that last week was our last show. But exciting news as well. If you're still listening, you're one of the cool ones, and we want to share with you that Launchpad, the thing we've been talking about here for a while, our 12-week live course taught by Taylor, by Rabih. I'll maybe do one or two in there, and then outside experts coming in to talk about really everything you didn't learn about money in dental school. We want to cover, and registration. When you listen to this, hopefully over the weekend, by next week, registration will be live. So you will be able to register for the first cohort of the Dentist Money Launchpad. But Launchpad will be coming out starting February 6th. So we would love to have you. If you want more information, go to dentistadvisors.com/launchpad. You can sign up for the wait list or just register, because by the time you hear this, it'll be days away from registration. So we'd love to have you. For now, Taylor, Rabih, thanks for being here and sharing your words of wisdom. Thanks everyone for listening. That was our 2 cents. Till next weekend, because we'll be back again. Have a good one. Bye-bye.